This is the East Bay Regional Park District Finance Committee. And I am going to go ahead and ask Shannon to tell us what the rules are for the actual.
Great, thank you so much. So we're starting at 11:05 a.m. And before we get going, Alex, can you confirm that we're streaming?
You are streaming. You're good to go.
Great. Thank you so much. This is Shannon Rice, recording secretary, taking roll. Chair and Director Ellen Corbett.
Are you calling
Calling roll.
Yeah, here.
G. Rosario.
Here, finally.
Thank you, Dee, and Olivia San Juan.
Here.
Thank you. This meeting is being held pursuant to the Brown Act. We are providing live video and audio streaming. Members of the public wishing to make a public comment can do so one of the following ways: live via this Zoom meeting, by submitting an email, or by making a comment in person, or leaving a voicemail. This information is located on the agenda located at the Park District's website, ebparks.org. If there are no questions about the meeting procedures, we can begin.
All right. It's May 31st, and we're beginning at 11:06. I want to welcome everyone to this morning's meeting. And thank you, Shannon, for putting together the room and getting us started here. Now, obviously, we're also here with our Assistant General Manager, Deborah Ocker. And our items this morning have been changed a little bit. The very first item we're going to be hearing this morning is the formation of Community Facilities District Fund Maintenance of Trails in the McGee Preserve Open Space Area. So we'll go ahead and start with that item. Good morning.
All right, good morning. Deborah Spalding, Assistant Finance Officer. Now I'm going to pull up my screen here so that I can show you our presentation. Give me a second. And how do I get back to the beginning? One more try there. All right. All right, can you guys see that? Yes. So I'm going to be sharing this presentation with Naoma Laval, who's joining us on Zoom. And this is the formation of a community facilities district to fund the maintenance of trails in the McGee Preserve Open Space Area. So Naoma will begin, and then I'll take some slides towards the end that are about on the more finance related topics. And then we also have also on Zoom, Tim Seifert here from NBS, and they're the consultant who's helping us with this formation. So I'm going to turn it over to Naoma, and Naoma, just let me know and I can move the slides forward.
Great, thank you. Good morning, everyone. Naoma Laval, Principal Planner in Planning Trails and GIS. We can move to the next slide. So Deborah and I are here today to present to you the Community Facilities District for the McGee Preserve Open Space property. This property and project is located in the town of Danville. It's adjacent to the northern section of Sycamore Valley, so you can see there in the red circle. It's located off of Diablo Road. That's where the primary access to the property really is currently, though access would also be available from Sycamore Valley in the future. It's located south of Mount Diablo State Park, and the project was approved in 2019 by the town council, and then sort of reapproved by Danville residents during the election in 2020. So Measure Y was what the town voted yes on to approve this project. Next slide. So the project itself, the McGee Preserve project, is a residential development project. There's a 410-acre property. You can see here it's just kind of south along Diablo Road. Of that 410 acres, 29 acres really consist of the development area, about 7% of the entire property, or 69 homes total. 381 acres of the property is to be retained as open space, and open space will also contain recreational trails. Currently, the agreement is 3.5 miles of trails to be managed by the Park District. And then there's an additional 2 miles more approximately that will be non-Park District public trails. So the town of Danville, there's some HOA internal trails. But so in general, there's a good amount of additional trail access as part of this project. And then you'll see kind of in that southern orange hashed area of this map, that is a conservation easement. It's a mitigation conservation easement. So it was required as part of the permit process for the residential development project. That conservation easement is to be held by John Muir Land Trust. So the Park District will be managing trails that go through that conservation easement area, but the easement itself is to be managed by John Muir Land Trust. So next slide. So the Park District, in agreeing to manage these trails, has also agreed to do the following actions as part of the trail responsibilities. So patrol and maintenance of the trail by operations staff. So that include like litter removal or kind of if there's a blockage or something along the trail, then staff would move it. And then maintenance and replacements of signs and gates and other things kind of along the trail easement area. And then also emergency response could be provided as part of fire, police, or kind of regular patrol by the helicopter unit. Next slide.
All right, so now it's back to me. So the whole point of the Community Facilities District, or one of the main points, is to generate funding to maintain these new trails that we'll be maintaining. So we worked with operations and public safety staff to determine how much is it going to cost. And so this spreadsheet, which is in your packet, it's a little bit small to see on this slide, but maybe a little bit easier to read in your packet on page 78. You can see the details of which staff will be working at that land on those trails, what their tasks will be, and the estimated number of hours, and any supplies or services that they anticipate needing in order to do that maintenance. So this cost model, this cost calculation, was reviewed and approved already by Davidoff Homes. And then what happens from this is that it gets put into a rate and method of allocation document, which is called an RMA, and that will be brought to the board of directors for review and approval on June 20th. And then here is a brief listing of the primary next steps in the Community Facilities District approval. So we're here today to give you a preview, get any questions answered you might have. On June 20th, the board will consider adoption of a resolution of intention to establish the CFD. They'll also look at the draft RMA, the rate and method of apportionment, which is that cost document, and then also the boundary map will be part of that June 20th packet. And then it gets published in the newspaper that there's going to be a public hearing. And on August 8th, it'll come back to the board for the full approval of the CFD formation. There will be a public hearing, a landowner election, and then the results will be declared at that meeting, and then also approving an ordinance to levy the special tax. Simultaneous to that, there are a couple other things that are moving forward: a public trail easement and a voluntary conservation easement, which will both they have like a separate track that they're moving forward on. And so we are looking for a recommendation today to bring this to the full board. So we're asking the Finance Committee to review this information and recommend it to the full board for action at the June 20th meeting. So I'll drop the slides now. And as I mentioned, we have several experts on hand if you have questions.
Okay, thank you very much. Do you have any questions? Oh, yes, go ahead, please.
Thank you, Director Corbett. I'll just add a little history with community facilities districts for the committee. So in the past, we have always said if there's going to be a donation of property to the district that is kind of really outside of what we're seeking, that we should seek funding for it. And so in the past, we used a mechanism called zones of benefit, which were part of the lighting and landscaping district rules. And we found that they didn't provide a complete costing for what the real cost of services were, because it didn't include public safety. Also, procedurally, it had a lot of different steps and there were limitations and things that we had to follow in the law. So several years ago, we introduced the idea of having community facilities districts to serve this funding mechanism purpose. We've done 2 others in that general area, I think in Danville and San Ramon. We also used the community facilities district model for Measure FF. So the district has used it a few times, and we do find that because you can outline the actual boundary and set the rate and method of apportionment or the tax levy based on a flexible calculation that it can be agreed upon by the district and by the one providing the donated land, it works out really well. Deb mentioned we have Tim Sufert from NBS, who's been our kind of our advisor and our administrator in these different formations of community facilities districts. We've had our legal team review it because we do have to follow the state law as we go through these steps. And when you create a CFD, there is kind of 2 options. If the houses are already built, it's a property owner election. If the houses are owned or not built yet by one owner, or I think it's less than 5 owners, Tim's going to correct me if I'm wrong. It might be 5 or 7. If there's a limit, if there
12 registered voters, Deborah.
12 registered voters. Thank you so much, Tim.
Sure.
If it's less than that, it can be more of a landowner election, which is what we are seeking. So the timing is such that we want to do a landowner election before there becomes 12 registered voters owning the properties, and then we can follow this procedure. And in your staff report, it lays out kind of the steps that are going forward that Deborah Spalding went over. So that's just the history that I wanted to give you. And I think the planning team was really instrumental over quite a few months, even years, working with the landowner to come up with this. And some of the reasons why we're doing this is because it's part of what was expected when the voters approved this Measure Y. So we're kind of following what the voters had requested for the park district to manage these trails and for us to, provide that oversight and public safety. That was part of the negotiations. So Naoma will probably answer any other really hard questions. Thank you.
Well, I do have a quick question, and then of course I'll open it up to the rest of us. On these, I'm looking at the operations monitor and management cost form here. Does this include, I see what it does include with regard to, there's the salary of workers and the work that they're doing. Does it include any other funds like money that goes towards eventual retirement? In other words, every item that an employee usually receives, is it paid for out of this type of situation?
That's correct. Yeah, the calculation was based on the full cost of the district, not I forget the Deb or Deborah, maybe you can step in with the
fully burdened cost is
fully burdened cost. Thank you. So yes, we did the calculation based on that rate, not just the salary, the take-home salary rate.
Okay, and will that amount change over time?
It may. We do normally include a CPI because this was somewhat unusual, this particular one, because we're only taking responsibility for the trails and not the land in general, we did work out with Davidoff that we would not be including necessarily the same CPI rate that we would have normally in the past. But that was kind of a special arrangement with the negotiation.
And that money is made available by the owner of the property and somehow puts it towards us to be able to pay the individual, or pay for their benefits, etc.
Yes, exactly. Yep.
Okay, all right, very good, thank you. Any questions? All right, please go ahead.
Yeah, thank you. I just want to clarify, because this is a landowner election. I just want, so this is an annual fee when the homeowners move into their homes, so they'll have to pay an annual. So my question would be is, what percentage of that of the home, of the price of the home?
So
Let's see. Go ahead, Naoma.
yeah, I'm not, so the Davidoff does a full calculation. My understanding is that all amounts levied on the individual homes has to be less than 2% of the total cost of the home. The amount that we proposed to Davidoff, the per unit cost, was acceptable to them. So it definitely fit into their limits that they have for any HOA fees or GAD fees or other fees that they might be levied on those homes as well, including property tax. All of that, I don't know the exact percentage, but it is within the limit that Davidoff had, based on what they anticipate the house is selling for.
Okay, great. And then to follow up on Director Corbett's question, CPI, when does is the CPI tacked on annually, or is it quarterly or semi?
So in our other CFDs, it's an annual CPI increase. As Naoma mentioned, in this one, we will not have a CPI. And really the cost of the park district, since this is mostly staffing costs, it's going to be based on what's negotiated through the MOU, what that increase is, and then whatever benefit cost increases we have. So it doesn't necessarily, our costs don't necessarily exactly tie to what the CPI is, which is it's the CPI for the Bay Area. So we won't have that escalation built into this, unfortunately.
Okay. Thank you.
Please go ahead.
So my first question is going back to the comment about responsibility for trails, not the land. Is this the only CFD where that's the case? And more specifically, I'm looking at the map that was in the packet, where it does show, the John Muir Land Trust section, but then it also does show regional park land. So will we have some land, and then on the John Muir Land Trust, we're just doing the trails? And so that's where there's a little bit of a mixture with this CFD situation?
I think on the map, the green is what we currently hold as Sycamore Valley.
Okay.
It's not part of this
Okay.
particular negotiation because it's already open parkland. We will not be having any land management, so we will not be owning the McGee Preserve open space parcels, neither the John Muir Land Trust or the remainder. I think that's an kind of a brighter red color on the map. We are only going to have trail management and maintenance responsibilities in that open space area. So the CFD will just be covering costs related to kind of management of those trails.
And is that different with the other two CFDs that we have, the Padva Faria?
That's correct. In our two previous CFDs, we were also receiving the open space itself in fee. And that was one approach that was proposed for this particular property itself, was the park district to own it in fee. And so we did have a higher cost per unit calculated based on that particular scenario. But for various reasons, the park district, the owning in fee was not going to work for the park district. So we agreed to maintain responsibility for the trails, hold a public access easement. It would look and feel as, in effect, an extension of Sycamore Valley, but we would not be owning it in fee or managing the open space land in fee.
And then do we manage trails for other properties that are part of the John Muir Land Trust? I believe we do. I'm just not as familiar with that arrangement.
Yeah, we don't, it's rather complicated, and we're happy to provide a more extensive update about
Yep.
kind of our relationship with John Muir Land Trust and the various scenarios. We have a very long history with them that's been, worked well for the park district. So in some scenarios, we own an interest in land that they actually manage as a park, like Fernandez Ranch, which is up in that area south of Crockett Hills, kind of by Highway 4. And then the most recently acquired property at John Muir Land Trust, Harvey Ranch. John Muir Land Trust owns it, and the park district will be holding a voluntary kind of conservation easement over it. There's no mitigation requirement, but it's just kind of to ensure it's preserved in perpetuity. But trails will be managed by John Muir Land Trust. So it's sort of, we have each one is rather unique. The different properties that we are sort of involved with John Muir Land Trust, and happy to provide a lot more information about it.
Of course, yes, and that's a good summary. So thank you. Yeah, I
Yeah.
may follow up just so I could better understand the overall picture with that organization. And then real quick, I'm also looking at the map. So the GAD, is that how you pronounce the acronym? I think I just heard that being
Yeah, that's
described.
the Geologic Hazard Abatement District. Yep.
Okay, so some of those fees would be then part of the home fees that Dee was asking in regards to HOA fees and other fees. And so can you just summarize real quick? So the geological hazard, the GAD, like what is that? Is that, it's land that can't be developed upon and just needs to be preserved as a buffer type of situation?
That was so GADs cannot. So in this particular situation, the abatement district, the Geologic Hazard Abatement District, the GAD, was identified as the best landowner for these properties because the entire property was going to be subject to restrictions related to the geologic hazards that were identified in this area. So the abatement district collects fees from landowners, and then if there's a landslide or another identified hazard that occurs, then the GAD can come in and make those repairs as needed. So that's kind of just really broadly. Because the entire property was going to be subject to it's part of the identified hazard area. The GAD itself, as a district, was identified as the best landowner, with kind of the public access easement held by the park district on top of that property to ensure that there continued to be public access.
And it looks like we'll maintain some trails during that, or in that on that land, on that red part of the map.
That's correct. Yeah.
So if there is something like some sort of hazard that happens that might affect those trails, would we then be able to use some of the GAD funds to
exactly
pay for those repairs? Okay.
The GAD would be fully responsible for repairing those trails. Yeah.
Okay, I believe those are my questions. Thank you.
Yep.
Thank you very much. And I have one last question. On the map, it also refers down in the left corner to potential new trail. So do these funds, are they set aside for potential new trails?
Sorry, I want to make sure I know exactly where that.
I could pull it up, but it is I believe it's the bike path that goes along Diablo Road that you and I had discussed earlier. It's a dash line. It says potential trail at Danville.
Yes. Apologies. Yeah, that is a town of Danville trail. That would not, the cost per unit that we're calculating for maintenance of the existing trail system that we'll have a public access easement over does not include the town of Danville trail. So the town of Danville trail will be built by the town of Danville as part of a capital project that they will initiate, and they hold a separate public access easement over that particular trail along Diablo Road.
Okay, that's good to know, but also the line above potential trail Danville, where the map is also potential new trail easement to East Bay Region Park District.
Oh, Yeah, so that's a little one that goes around the white in holding. That's an East Bay Mud held property. It's a former tank site, and we cannot record a public access easement over that particular in holding. So Davidoff will be building us a new trail segment that kind of goes around that white in holding property, and that they will be building it. And yes, the CFD will include management of that kind of reroute of the trail.
Okay, good to know. Thank you
Yeah.
very much.
Yeah, no problem.
Any additional questions?
Just one.
Yes. go
Just,
ahead,
I
Dee.
just wanted to confirm, so we have we go over the CFDs annually. And then it's open for a public hearing, and then if there's any appeal process from the voters or the homeowners, that's their time to speak up. Is that right?
Going to ask Tim Sufer to talk about whether there's any annual appeal process on community facilities districts, if that's okay, Tim.
Sure. I'm going to wade into a little bit of a deep subject there. So the CFD is, you can levy it by ordinance, where it really would just come to the board as a matter of information only each year. That's typically the way that it is done. So the tax would be levied each year up to the maximum. The board has the authority to levy, at any rate up to the maximum. There is kind of a lack of a better term, a poison pill, if you will, in the RMA, that if the people got together and wanted to overturn it at some point, that the district would then be able to not provide the services. That makes sense.
Thank you, Tim. And I think
Is that helpful?
Director Rosario, you're also thinking of the lighting and landscaping district process, where there is an annual kind of protest hearing. The community facilities district does not have that. We just do an annual informational report, as Tim mentioned.
Right. An assessment district requires an annual engineer's report and a public hearing for transparency. It's just a different rule. And while my microphone is on, the GAD is a form of an assessment district. I think that was mentioned, but just to clarify.
Thank you for the clarification.
Thank you very much. One of the positive things to think about is the fact that the developer was interested in making sure that there was some nice open space and a beautiful place for people to, have a trust to take care of the nature area. So that's really, that's a very positive thought, and we thank them for that. And this is part of that too. So any other questions or a motion is in order?
I'll make the motion to approve.
Okay, we have a motion
I will second.
and we have a second. All those in favor, please state aye. Oh, that's right.
Thank you. Recording Secretary Shannon Rice, calling roll call vote. Director Corbett,
Aye.
Director San Wong,
Yes.
Director Rosario.
Aye.
Thank you.
Okay, that's 3 aye votes. It has passed. Thank you very much. Thank you all very much for all your work.
Thank you.
All right, the next item we're looking at is the one that was listed as first on the agenda, the March 31st, 2023 investment report and portfolio review.
All right, good morning again. Deborah Spalding, Assistant Finance Officer, and I am pulling up a brief presentation, and so I will walk you through an overview of the first quarter investment report, and then we have staff here from PFM. There are investment advisors, and they'll walk you through in more detail the district's investments, as well as some information about our ESG, environmental social governance score on the portfolio. So what I'm going to do first is walk you through in a little bit of detail the large table that you have in your packet on page 3. So just kind of breaking it down into different chunks. And so the first chunk we're looking at is the liquidity portfolio. And so that's at the top of that page. And so these are the funds that are easily convertible, either are cash or easily convertible into cash. And so just a couple things to highlight for you. One is that during the first quarter every year, we're always drawing down on our cash balances. So if you compare where we are in total with our cash compared to where we were at December 31st, we're about 15 million lower. And that's because we got a big property tax payment in December, and then our next significant payment comes in April. So we're drawing down on the cash balances during the first quarter of the year. And then another question we often get is there's a negative number showing up in our demand deposit accounts, and that's showing that we have that's like a pooled, like all of our bank accounts pooled together. So we have more accounts payable, checks going out than we have checks going in as of March 31st. So it's just a snapshot in time of showing where we were at that point. So that's what that negative is. Moving a little bit down on the page, looking at the invested securities, just a couple things to point out here, and PFM will go into this in much more detail. So the district increased its investments in treasuries and corporate bonds, and that has to do with, you know, what are the best investments, what's performing best during this time period. And then lastly, moving down to the bottom part of the page, looking at our project funds and our debt service funds. And the main thing to bring to your attention is that we are slowly continuing our Measure WW bond drawdowns as those projects are underway. So you'll see a small decrease from the end of 2022. So that's all I have, but PFM is now going to present in greater detail. And then at the end, we would like to get a recommendation from the board.
Thank you very much.
Thank you. Good morning. Good morning, everyone. It's a pleasure to be with you today. I'm going to introduce myself. I've certainly presented to this committee before, Monique Spike with PFM Asset Management. I am joined by two of my colleagues, Allison County from PFM Asset Management, and also Sarah Walsh. We are going to present a little bit about the economic activity that occurred during the first calendar quarter. We'll touch upon some of the current economic stories and how it relates to the portfolio. And then we will round out our presentation with some information on the return of the district's portfolio and a summary of the environmental, social, and governance criteria that we are using to evaluate some of the securities. Allison County is going to start us off by talking about the market. And then we'll have—
Yeah, thank you, Monique.
Allison.
Yeah, I'll just go ahead and share.
Thank you, Allison.
Yeah, I believe you should be able to see it. Please let me know if you can't. Are you able to see the presentation?
Yes, thank you, Allison.
Great, thank you. Yeah, well, good morning, everybody. As Monique said, I'll just start off with a brief economic and interest rate update to kind of show you or summarize what was happening during the first quarter of the year. So the major themes during the quarter, the one we've been talking about for quite some time now, is that inflation. However, it is steadily declining. Inflation for March, as measured by the Consumer Price Index, or CPI, was 5%. April came in slightly lower at 4.9%, so meaning prices rose 4.9% year over year. This did mark the 10th straight month of declining inflation as measured by CPI. However, it does still remain well above the Fed's 2% target. And we continue to see, high prices in shelter, transportation, entertainment, a lot of the services, even food is still, those prices are still rising in some sectors. The labor market remains strong, although it did show some signs of moderation during the quarter. I know the unemployment rate was below 4% during the quarter. However, we did see the number of job openings decline, and we saw slightly less wage growth. The Fed is looking for the labor market to cool. They think that will aid in the whole bringing down inflation piece. And so to see the labor market cool a bit is not necessarily a bad thing. And then at the end of the quarter in mid-March, We saw the surprise failure of several banks, including Silicon Valley Bank and Signature Bank. And then with that, just a general decline in confidence of the banking sector as a whole. This led to significant volatility, as well as a fall in interest rates in the bond market. Following the bank failures, just to note, we, PFM Asset Management, did put purchases of financial issuers on hold. One, we wanted to give the markets a chance to calm down. Again, that significant volatility with yields just kind of swinging daily and day to day. So to let the market settle down. But we also wanted to give ourselves, our credit research team, a chance to review our approved issuer list. That list where we have the issuers that we buy securities for our clients' portfolios. And we wanted to review all of the financial names on there. And then over the next few weeks, those names were added back. We began purchasing again. And I will note that we did not sell anything from the district's portfolio because there was a concern over the credit quality of that issuer. The Federal Reserve, as I mentioned, continued to try to fight inflation during the quarter. The Fed has primarily been doing this by raising their Fed funds target rate. The Fed raised that rate at both of their meetings during the quarter. At their February meeting, they raised that target rate by 25 basis points, so it's 0.25%. And then they did that again at their March meeting. And that left the rate at quarter end at a range of 4.75% to 5%. As a reminder, March of 2022 saw that rate at a range of 0% to 0.25%. So the Fed has hiked that target rate about 500 basis points or 5% over the course of the past year. And again, they are doing that to try to make money more expensive, slow down the economy, ultimately lower inflation. At quarter end or at the end of March, following that March meeting, the Fed did indicate that they were nearing the end of their rate hikes, and that then they would likely keep rates elevated through 2023. The market at the same time was thinking that the Fed will likely cut rates in 2023. That view has since changed, and I'll talk about that a little bit later. I mentioned the bond markets and the volatility. So with the bank failures, we just saw really unprecedented volatility in the bond markets. I'm just noting what happened with the 2-year Treasury, which was yielding slightly over 5% on March 8th, just a couple days before the bank failures, moved to under 4% and ended the quarter at 4.03%. So just a wild swing in Treasury yields. Yields across the yield curve beyond about 6 months moved slightly lower. I'll turn the page as I talk about this. This page here shows the US Treasury yield curve. So if you look at the bottom, we're showing yields on US Treasuries with maturities from 3 months out to 30 years. And what we see here, if we look at the dotted line, which is the start of the quarter versus the solid line, which was the end of the quarter, is that besides those very short maturities, 3 months, 1 year, interest rates moved lower during the quarter. And that was a result, and really all that movement lower came at the very end of the quarter due to a flight to quality as investors sought the safety of high quality fixed income, including treasuries, but also federal agencies, high quality corporate notes. So that pushed the yields lower as demand increased for those securities, prices moved higher and yields moved lower. And so we saw a drop in interest rates during the quarter. That shaded blue line shows you the range of interest rates over the past year. So while we are down off the highs we've seen over the past year, which would be the top of that shaded area, rates are still quite elevated and near their highest levels in about 15 years. Turning to the next page where we talk about returns. So here we're showing the total return on various fixed income indices with durations of 1 to 5 years. And the different sectors that we're showing are sectors where we purchased for the district's portfolio. And the left-hand side shows the total return just for the past quarter. And you can see for the past quarter, all four of the sectors we show there had very strong positive returns. Those returns are just for the 1 quarter alone. So really strong returns. And that was a result of those, primarily the result of those falling interest rates, which leads to unrealized market value gains. What you can also see on that chart on the left-hand side is that for the quarter, the US Treasury sector performed the best. They outperformed federal agencies, but also credit instruments, credit sectors like asset-backed securities and high-quality corporate notes. And that's because of that, that flight to quality where investors sought the safety of all these asset types. Treasuries saw the most demand, and so those yields fell the most, resulting in the biggest market value gains in the Treasury sector. And then the chart on the right-hand side shows you the 10-year return of these same sectors. So you can see also very positive for the past 10 years. These are annualized returns, so they average yield each year for the past 10 years. But you can also see that over the past 10 years, credit sectors have outperformed government sectors. So asset-backed securities, corporate notes have really produced good, strong returns relative to treasuries and agencies. So just kind of a reminder that even though this most recent quarter, treasuries were the best sector, over the long term, we see that having those credit instruments, a diversified portfolio does typically benefit. Excuse me. Just turning here to the last page in the economic update, we're looking at some projections that the Fed releases to kind of get a sense of what to expect going forward. The Fed releases these projections 4 times a year, and we're showing the 2 latest ones. Their December projections in the lighter bars, and then the projections from their March meeting in the darker bars. And then, so you can see if we start in the left-hand corner, well, first, big picture, their projections didn't change much quarter over quarter, even despite the issues in the banking sector and the impact that could have on growth in the US economy. Their projections didn't change a lot. When we look at their projections for GDP, we do see that the Fed expects growth to really slow down here in 2023, only a 0.4% for the year. You will note, though, they do expect positive growth, just quite small. And then the next couple of years, still relatively, below what we've seen pre-pandemic, but positive growth expected for the next couple of years. The upper right-hand corner is the unemployment rate. The Fed showing they expect the unemployment rate to be 4.5% in December. The unemployment rate in March was 3.5%. So that means they do expect the unemployment rate to move higher. I mentioned that, the Fed's tightening cycle, they do expect the employment sector to face some challenges because of that. And so they do expect unemployment to increase during the rest of this year. In the lower right-hand corner is the Fed funds target rate. So projecting a 5.1% for that rate to be. And that's where the rate is right now after their May meeting. That target rate is at 5.1%. So this would say that the Fed is done with rate hikes in 2023, but that they don't expect any rate cuts in 2023. You see for the next couple of years, they do show rate cuts. The Fed thinks that rate over the long term should be around 2.5%. So over the next couple of years, the thinking is they will lower that rate to get to their long-term goal. And then finally, inflation on the left-hand side. Here we're showing a PCE inflation, which is the Fed's preferred measure as opposed to CPI that I mentioned earlier. Just measures different pieces of the economy. PCE is always lower than CPI. So the Fed's projecting 3.3% at year end. Still above the Fed's 2% target. They don't think they will get inflation down to that target for the next several years, but you can see they do expect it to continue to move lower. I'll now move into the district's portfolio. First, starting off, just your certificate of compliance.
Excuse me, just one moment. We have a question.
Yeah, before you move on, before I lose my train of thought too. So you mentioned that because of the high interest rates established by the Feds, I wonder if there's an opportunity, and then the lowering of the percentage for the treasury bonds. I wonder if there's an opportunity here to make up for some of that with investing in high yield CDs.
Yeah, you know, the district does have the option per code and your investment policy to invest in and I assume you're talking about time CDs at the bank. Yeah. So it is an option. You know, PFM, we would not purchase those on behalf of the district. That is something that, you know, the finance staff would do, similar to how you have, you know, your own deposit accounts and things like that. So it is a possibility that, you know, the district could do that if that's something that you were interested in.
And Director Rosario, I'm going to add a little bit more color on that. The district has a good amount of assets in liquidity vehicles such as LAIF, which is a state investment pool, and CAMP, which is a California Asset Management Program. As rates have gotten higher, the district has benefited greatly from having assets in some of those liquidity pools. CAMP, for example, is paying a very attractive rate. As part of our strategy, the longer term securities portfolio, which PFM Asset Management manages, has been to look at locking in some yields in securities with 2-3 year maturities, for example, because we do anticipate rates to decline next year. Now, certificates of deposit are an option, but they do lack some flexibility in that typically when you do use time CDs, you're locked in. It doesn't have the same liquidity and flexibility as some of the securities in the portfolio, and it's not going to necessarily benefit from rate increases like your liquidity funds. And so I just say that to say that the strategy that we're doing now allows you that option to lock in some yields while also benefiting from the rising rate environment with the short-term assets.
Great, thank you. And then question about the yield curve. Typically, that when the yield curve inverts like it has, it usually portends a recession of some type. And it looks like the PCE said there's going to be a lower amount of recession versus what has been done historically. Is that correct?
Yeah, that's accurate. So the yield curve right now is inverted, and longer term yields have declined and have been in decline because of the anticipation that growth would slow. The Fed has been fairly straightforward on their assertion that they do not expect negative growth. As you saw from those growth projections, they're still expecting positive growth for this year and next year as well, although lower growth than they had previously anticipated. It's interesting that the market is still sort of very negative in our projection. If we're talking about the market as sort of this monolith whole, but the yield curve is sort of anchored down because of those expectations that growth will slow and will continue to slow.
And then my last question is, what's the difference between the PCE and the CPI? What are the different comparisons there?
Oh, great question. So CPI is your headline inflation number. That's the number that you'll hear typically quoted on the news. And CPI is reflective of a basket of goods that, there are things in the basket that you would assume people buy. PCE stands for Personal Consumption Expenditure Index, and that is the Fed's preferred gauge of inflation. The key differences between PCE and CPI are that PCE will include things that we pay for but aren't necessarily goods. For example, medical insurance. So what you're paying for medical insurance, and also what's paid on your behalf for things like medical insurance that are typically paid, for example, by your employer.
Excellent. Thank you so much.
Thank you. We have another question.
So, since we're talking about this is related to some of the questions I was going to ask, is what Dee was asking in regards to the projected GDP growth, the slowed growth. and I've also heard the term soft landing being used as well to describe kind of the next 2 years or what's anticipated for the next 2 years. My question is a lot of, I guess, local municipal leaders keep on talking about how the recession is going to happen soon and we need to plan in terms of this recession. Yet, I see a lot of talk about a soft landing or just slowed growth, but not negative growth. And I'm just curious if you have any, talking points as we talk to some of our colleagues who manage our, the cities within our park district in terms of how we can have these conversations with them in regards to this projected information.
Yeah, that's a great question. That's such a rich question. There's so much in there. A couple of thoughts on that. The idea of this hard, I'll start with the idea of the hard landing, because I think that's where a lot of this starts, right? The Fed has been on this aggressive campaign to raise interest rates pretty much since the start of a lot of city fiscal years. So if you're talking about cities, they're on sort of a 7/1 to 6/30 fiscal year. And the Fed really started that aggressive rate increases, at the sort of the beginning of the fiscal year that's ending on June 30th. And so typically what you would see when the Fed acts in that manner is you expect the economy to come to a screeching halt, right? Borrowing rates are significantly higher all of a sudden, home equity lines of credit have increased, borrowing costs have increased, folks have variable rate mortgages. So it's had this expectation of really grinding the economy to a halt. That's sort of the purpose of their plan. With that, unemployment was supposed to sort of balloon. All of that was supposed to take place. I say that we are currently at the landing point for the Fed's policy, right? The Fed has essentially completed their rate tightening cycles, right? The short-term interest rate is as high as the Fed has told us it's going to get. And so I sort of look around and say that, we are here, we're in the landing point for this policy. Now it has some time to sort of sit and marinate in the economy. But, the things that have, happened so far, folks have experienced higher borrowing costs. We've seen, variable loan rates balloon over the years. We've seen an impact on unemployment. And so it's a soft landing because it's not as bad as I think was anticipated. Right. And we're currently sort of sitting where we are. And so I think what's going to happen now is, as folks get used to the current interest rates, as folks sort of think about their borrowing and capacity to build, to borrow, et cetera, at these rates, we're going to see how the economy lands with it. But we are very much, I think, in a soft landing. And I would argue that we're where we are supposed to be. The Fed is in wait and see mode. And the next steps for the Fed, if things continue on as they have, is for them to start lowering rates, which should be an economic boon next year.
And then as a follow-up, living here in the San Francisco Bay Area, locally, I think that we may feel a little bit more of the impacts because of the tech sector and also, Silicon Valley Bank having been headquartered here. Do you have any thoughts in terms of, the local situation in the Bay Area in regards to everything that's happening and all of the uncertainty compared to the broader U.S. economy?
Yeah, I think the Bay Area certainly bore a big brunt of the layoffs in the tech sector. There was also a bit of overhiring in the tech sector during the pandemic. So in some ways, that's a bit of leveling out. I don't think that our big city center, speaking of San Francisco, has recovered as much as some of the other city centers across the country. And so I think you're seeing that has to play itself out, but there's certainly not as much recovery in this area as there has been in other parts of the country. So the Bay Area is something to watch.
Okay, that's all. Thank you.
Thank you.
Any other questions? Otherwise, I'll have Allison and Sarah conclude with the report.
You can go ahead with the report. Thank you.
All right, thank you. Thank you, Monique, for your help in answering those questions. I'm sorry, I had an issue with my audio. I hope you can hear me okay now and that it wasn't too distracting. So here I will turn to the portfolio snapshot page. So the funds we are showing here and that we will be discussing on the next few pages are just a portion of the district's funds. Deb covered all of them. So this report excludes the funds in the liquidity portfolio, so those overnight accounts. It also excludes the bond proceeds. So this bucket of money, sometimes referred to as the operating funds, comprises about $145 million at quarter end. The portfolio has a duration which is similar to average maturity of 2.38 years. This duration is slightly short of around 95% of the benchmark duration, which was 2.5 years. And if we look at that chart in the lower right-hand corner, which shows the portfolio's distribution in blue versus the benchmark, the benchmark is noted in the footnote, and it is the 1 to 5 year U.S. Treasury Index. So it comprises of all U.S. Treasury securities with maturities between 1 and 5 years. You can see when you compare those duration distributions, the district's portfolio has a slightly lower allocation to that 4 to 5 year maturity bucket, with a fairly larger allocation to that 0 to 1 year bucket. So helping achieve that overall slightly shorter duration position. We have been managing the duration a little bit short, again, around 95%. For the past year or so, as interest rates have been moving higher, having that shorter duration helps protect some of the portfolio's market value relative to the benchmark as rates are moving higher. The portfolio at quarter end had a yield at cost of 2.43%. The yield at cost is essentially the earnings rate on the portfolio at March 31st. This yield we've seen move up a fair amount over the past year as we've taken advantage of those higher interest rates, purchasing higher yielding securities for the portfolio. And just over the past quarter, that rate increased by 26 basis points, so 0.26% increase over the last quarter. The portfolio is of very high credit quality. The average quality is AA rated. And then the sector allocation in the upper right-hand side, it's very diversified. About half the portfolio comprises U.S. Treasury securities. About 60% of the portfolio is treasuries and federal agencies. And despite what is currently happening with the debt ceiling and the concern about a potential default, U.S. Treasuries are still considered to be, one of the safest, most liquid investment types. The remainder of the portfolio, the other 40%, is comprised of other asset types allowed by your policy and code that traditionally provide some additional return and interest earnings potential, including corporate notes, asset-backed securities, municipal obligations, and supranationals. So a very well diversified and colorful chart. If we turn to the next page, we can see the portfolio activity during the quarter. The chart on the left-hand side lists the different sectors where there was activity, and then the sales or maturities are shown in the gray bars, and then the purchases in the blue bars. As Deb mentioned in her overview, the allocation to high-quality corporates and U.S. Treasuries increased during the quarter. The municipal sector also increased slightly. So this was a good quarter where we found value in corporate notes, able to further diversify the portfolio. You see on the very bottom there, federal agencies. So we sold out of federal agencies. This has been a trend for quite some time now. There just really is limited value in federal agencies, meaning the interest rates are about the same, sometimes even less than U.S. Treasuries. So when it comes to the government space, we prefer to sell federal agencies and to utilize those proceeds either in U.S. Treasuries or this most recent quarter adding to the corporate sector. Next, we'll turn to the performance of the portfolio. So like the sector market performance we saw earlier in the report, the portfolio, as well as its benchmark, also had very strong returns for the past quarter. So if we look at the 3-month column here, we can see the components that make up the total return figure. That is your interest earned, so realized earnings on the portfolio, plus the change in market value, which includes unrealized gains or losses, plus realized gains or losses.
This quarter, because rates fell, as we talked about, you had unrealized gains in the portfolio, a market value appreciation on the securities, leading to that total dollar return of just under $2.6 million. On a percentage basis, that equates to a return of 1.80%. The portfolio just slightly underperformed the benchmark for the quarter mainly for the reasons we talked about earlier, is that treasuries performed the best. So the portfolio's allocation to some of those other sectors kind of hurt the performance relative to the benchmark for the quarter. But if we look over the longer term, past 5 years, past 10 years, you can see the portfolio's done quite well relative to the benchmark. Over the past 10 years, the portfolio returning a 1.07% each year on average, outperforming the benchmark by 21 basis points each year on average. And then lastly, in this section of the report, the accrual basis earnings, so removing those unrealized gains or losses, just looking at the realized. Again, you have your interest earned, same number we saw earlier. And then we also show you here the realized gains or losses on sales. You do see that realized losses were a net negative for the quarter. That's because when we're selling securities that were purchased several years ago. So the interest rates on those securities are much lower than what is currently available in the market. And as such, you do take a loss on the sale. However, we are using the proceeds of those sales to purchase investments that are currently, have yields at their highest levels in over 15 years. So we're adding very high yielding investments to the portfolio that will help increase the earnings, and make up for those losses over the life of the security. Just briefly summarizing, the purchases with those losses on sales. We purchased securities that had an average yield of 4.4%. Maturities, the average maturity was about 4.5 years. So adding those high yielding securities in longer term purchases to really lock in that interest rate to provide the district the benefit of those higher earnings moving forward. The next section is the ESG overview, and I'll turn it over to Sarah, but real quickly before I do that, just kind of looking ahead, I mentioned earlier, the Fed raised that target rate once more in May and kind of signaled they were done raising interest rates. However, some recent economic data, including higher than expected inflation reports, strong retail sales in April, and a very strong April jobs report, is now leading the market to believe the Fed might have one more rate hike in them this year, sometime over the summer. The market does still think they might see rate cuts late in the year. But whether the Fed hikes one more time or not, and even if there is one cut this year, I think we can expect to see elevated rates for some time, which will provide great opportunities for the district's portfolio to continue to add these high yielding securities to the portfolio. And just finally, before I pass it over, I will mention that the debt ceiling. So as a reminder, the Treasury reached the debt ceiling earlier this year and have been using various accounting measures to keep paying their bills. However, on June 5th, Monday, according to Treasury Secretary Yellen, the Treasury will officially, not be able to pay all of its debts. There is, of course, a plan that was just recently presented to the House, and so that will be debated over the next couple of days and hopefully approved. So far, the markets haven't really reacted too much to the issue. We have seen yields on those Treasury securities that mature next week and the following week. Yields kind of spike on those maturities. However, the rest of the market has been pretty calm. The district has no Treasuries maturing in 2023, actually. So really no impact on the district's portfolio as yet. Beyond the district's portfolio, it's expected that a default, even a short-lived one, could have, negative impacts on global financial markets, could result in job losses, declining growth in the U.S. And so, we certainly hope that a resolution can be achieved and hopefully by Monday. So with that, if there's any other questions on that section, I know it's, well, actually you asked them all previously, but if there's any other questions, otherwise I can turn it over to Sarah.
Thank you. And I know we're over time, and so we're thoughtful about the time here. So I will ask, I've asked Sarah to be brief unless there are questions. Thank you.
No questions at this moment. Thank you.
And Sarah, you're on mute. And we still can't hear Sarah. So I will start while Sarah works on her volume in the interest of time. So the district has a environmental, social, and governance policy that we use as a factor in selecting investments for the district's portfolio. Now the ESG criteria, of course, falls below the safety, liquidity, and yield primary objectives of the portfolio. But the goal is to have a portfolio that's reflective of the district's value. Of the portfolio assets, about 50% of the portfolio is in security types that have ESG ratings, and you can see they're highlighted in green here. And so there's about 63 of the 71 issuers in the portfolio and a total market value of 145 million. On the next slide, thank you, Allison. We show the quarter-over-quarter summary changes in the portfolio. Now, what you want to focus on is the green, which is the portfolio, the green lines in the exhibit to the right, which is the current quarter. A couple of things. You want your ESG risk rating to be low. And so you can see here that we've actually moved a bit lower from last quarter. The lower the ESG risk rating, that means that there's either not a lot of exposure to environmental, social, and governance risk in your portfolio, which is a good thing, or it means that the risk in the portfolio is being managed well by the individual issuers. And so the goal is to have a lower ESG risk rating, and so we're moving in the right direction, to have exposure to be low and to have the management of that exposure be high. And so you can see here that the rating was a little bit lower, but fairly consistent, and the district is within our stated goal of being minimum to low ESG risk. On the next slide, we have some additional ESG information, which I can share. And I'm looking to Sarah to see if there's anything we want to highlight in this section. We still can't hear it, but I don't think so. If you scroll through, I'll tell you what's in the packet so you can have an opportunity to look at it a bit later. We essentially sort of summarize the different themes, essentially what the environmental, social, and governance risk that we're managing and what they do. And you can see sort of in the exhibit on the bottom where that risk exists in the portfolio. On the next few slides, we go into the individual ESG risk ratings by sector. So you can get a sense of exactly what type of risk exists in the portfolio and how much of that risk, again, is being managed. And when we say managed, what we mean is, for example, if you are a company that has some exposure to environmental risk, what are you doing about that? How are you containing that risk in the decisions you're making at the company? And the next few exhibits just go into the ESG risk per company in the issuers in the district's portfolio. And we will conclude there with our formal presentation unless there are additional questions.
All right, thank you very much. Any questions? Yes, please go ahead.
I'll try to keep these questions short to the point, but the supranational category. So that includes a lot of the larger global companies in the portfolio. I think I saw some companies like AstraZeneca, Roche, Nestle, so they would roll up into that supranational.
No, supranational is actually a category of investments that's specific to corporations in which the shareholders of those corporations are nations. And so the World Bank is a supranational, the Latin American Development Bank, those are all sort of supranationals, and the district has some exposures. Now, supranationals are considered in the sort of government category because of the types of organizations that they are, and there's some of the AAA exposure in the portfolio.
And then my second question is, do we do a breakdown of, I guess, international versus domestic investments? So again, the examples that I just pulled when I quickly looked through the list, AstraZeneca, Roche, Nestle, do we maybe look at kind of that percentage?
Yeah, that's a great question. So each investment that we purchase for the district is US dollar denominated and are often from the US corporate domestic issuer for some of the global corporations that you may see on the list. So even if there is a global corporation, we're typically purchasing from the US domiciled operating entity, subsidiary, et cetera, all in US dollars.
Okay, thank you.
You're welcome.
Okay, thank you very much. Next,
Thank you.
are we moving on to the next item or?
Oh, we just need a recommendation.
Oh, sorry. So we're at the end with this one. Okay, very good. Is there a motion to support this?
So moved.
Okay.
I'll
moved.
second.
Okay, moved and seconded. Please call the roll.
Recording Secretary Shannon Rice, calling roll call vote. Ellen Corbett,
Aye.
excuse me, Director and Chair Ellen Corbett, Director Olivia San Long.
Yes.
Thank you. Director Di Rosario.
Aye.
Thank you.
All right, that's unanimous and it passes. Thank you very much. We're on to the next item. Next item, is it the authorization to renew that one? Is that where we are?
Sure. It's
Okay. Yeah, that's right. That's right. Authorization to renew the East Bay Regional Park District's insurance program. Yes. Okay. Hello.
Good afternoon, directors. Alma Balmas, risk manager. Today, I'm going to be giving you a brief overview of the 2023-2024 insurance program renewals. It's that time of the year. And so just wanted to recap all of the insurances that we have with the district: general liability, property, excess workers' compensation, aviation and watercraft, cyber liability. We also have other coverages that's not through PRISM. PRISM is our risk sharing pool. It's the Joint Powers Authority. But with Alliant, we hold crime and a small bond with Western Surety. So just a quick overview of the insurance program. We do have a very favorable loss history, and we've been able to manage our losses within our self-insured retention limits, with very rare occurrences where we've had to tap into excess insurance. So it's good in terms of our losses and not having to tap into excess and have excessive claims, which helps our premiums. The California market does continue to be challenging. We last year had reinsurers leave the pool, so it means that the reinsurers that are still part of the pool have to cover those losses amongst less reinsurers. We know that State Farm in the last week, I believe, has declined to insure and issue policies for homeowners and property owners because the market is so challenging in California and the risk of wildfires. And so we know that even giants like State Farm, who insures 20% of properties in the state, they're also leaving the market, even though they're still continuing with auto and other coverages. The market trend for liability claims, it's climbed 11% for over a decade. So what we thought was a few bad years has really established as the new trend. It's really looked at as the new normal. And so that's why you'll see for general liability, we're at 35% of an increase, but it's still lower than what we estimated this time last year, which was 55%. So 20% improvement. Just to take a closer look at general liability, the increases that we're seeing is likely, most of it is attributable to a steady 15 to 20 year soft market. So 15 to 20 years ago, we had a really viable market where competition was fierce in terms of insurance. There weren't a lot of losses 20 plus years ago. And so there was a competitive market, and then losses started to come in. So when the market started to harden in the late 2010s, that's when we started seeing these huge increases that have continued to balloon over time over the last decade. Just to give you a sense of what that looks like, in 2013, 2014, general liability claims started to resolve at an average of 20 to 30 million. And before that, things of that nature in terms of liability were resolving at 5 to 10 million. So it's been a huge increase and a jump since then. We see insurers reducing capacity. So they will write the risk, but they're limiting it in terms of how much they want to take on. So they're reducing capacity, and they're also holding aggregate limits. So if you have several claims, but you reach an aggregate that is the max that they'll go, they're really holding to that and not insuring beyond what your memorandum of coverage is. This chart really demonstrates what it looked like. The first set of bars is 10 years ago, 7 years ago, 5 years ago, 3 years ago, and now. And so you'll see the yellow bars represent the averages of the top, what does that say, 10 claims. And so when we look at 10 years ago, 6 million, that held true 7 years ago. 5 years ago, it increased to about 6.5 million for average loss of a general liability claim. And now we're looking at about 18.5 million. So it's really jumped over time, and it really is kind of the state of the market. It's not specific to where we are in PRISM. We're seeing it industry-wide. Yes, Director
I have a
Sanwó.
question. Thanks for all this great news.
On that previous slide,
Yeah.
is that the overall PRISM data, or is this just specific to the Park District?
This is overall pool data. So it's all the public agencies that participate in the general liability program with PRISM. Ours are thankfully not like this. We've been very good.
Just a follow-up question.
Yes.
So is the 18.5 million, is that indicative of the recent storm damage?
It is not. So with what we see from PRISM in terms of who's in the pool, they're anticipating losses from the 2023 winter storms to be about an average of 16 million so far. I know at the district, we alone have 14 million, and then a small percentage of that is going to be insured, maybe a quarter of the 14 million that we were seeing as our total loss. Still a rough estimate because we're still working through assessments and what that looks like. But we did have a walkthrough on May 10th with our claims adjusters, as well as a construction consultant, to basically give us an initial assessment in terms of valuation and what we might be able to recover.
Excellent, thank you.
Sure. So a snapshot of the property program, we still maintain a 25,000 self-insured retention limit, which means anything in excess of 25,000, we're able to submit a claim for review and hopefully acceptance to have any excess loss covered through PRISM. The estimated premium increase for property is roughly 27%, which is generally the same as what we saw last year. Some of our prior losses include the 2017 storm. So it's a very long process in terms of cost recovery. I think we finally wrapped that up in 2020. We also had the 2020 Vasco Hills Ranch fire, which is still in progress in terms of design and construction and getting that back up to par. We had a 2020 business interruption claim and a 2021 Miller Knox Ferry Point pier collapse when it collapsed the first time in January of that year. So the most recent loss we just talked a little bit about for 2023 winter storms. California as a whole the industry is looking at 1 billion or more in estimated damages. And so a lot of the reinsurers held off on including the damage estimates in the 23-24 premiums because there's just so many unknowns right now that they didn't want to balloon what premiums would look like this year without really understanding the full landscape of what happened. So we can expect to see that manifest in 24-25. So during 23-24 policy period, we did add the Dumbarton Quarry Campgrounds to our property schedule, the McLaughlin East Shore Brickyard Cove, Hayward Shoreline, and Point Isabel reinforced pedestrian bridges. So whenever we make capital improvements, that's a plus for us in terms of insurance and showing that the district is making good faith attempts to control our losses. And then we also secured coverage for the Regional Parks Foundation new lead space in Pleasanton. Just a recap of other coverages, we still maintain our aviation policy for the 2 helicopters that we have with the police department. And we also added a drone endorsement for our ASD drone that does aerial footage that we need for land and planning. Cyber liability premiums still continue to increase due to ransomware, malware attacks over the last few years for public agencies. So 3 to 4 years ago, just to give you a sense, we may have, as public agencies, have paid out tens of thousands, hundreds of thousands in ransom payments. Over the last 6 months, public agencies have paid out 10 million or more. So we see this as being an active threat. I know talking with David Rusting, our CIO, he is implementing a cybersecurity program with the IS team and has put some measures in place to add additional security layers for our data. Yes, Director Rosario.
So what does that actually cover? I mean, does it cover the actual ransom, or does it also cover, what does it cover?
That's a good question. They actually put a very clear exclusion in the most recent memorandum of coverage that it does not include ransom payments. That wasn't clear before. And I think they started to see a lot of the losses were public agencies trying to recoup or cover funds for that. So there's a clear exclusion that it doesn't cover ransom payments, but it does cover say if we were working with clients, loss in data breaches to sensitive information, damages to credit if it was as a result of us having our financial data stolen, any infrastructure that we'd have to rebuild or reconstruct or replace because of a breach.
Yeah, if there is a breach, would that also help? If there is a loss of data for employees, would that help employees recover or?
Yes,
damage?
I have seen losses, not at the Park District, but in my prior stint at a public agency where employee data was stolen. And so what PRISM offered is free access to a credit repairing agency or anything that might have compromised their sensitive financial data. And so they were able to work with a credit repairing agency to look into that and assess what losses might have occurred and help the employee recover.
Yeah. No, I'm glad we're focused on this because at the CARPED conference, it was brought up that they showed that how many agencies in California have been hit. It's astronomical.
It's a lot.
Whoa. So yeah, I think it's good that we're paying attention. Thank you.
Sure. Excess workers' comp premiums are also increasing, but they're roughly flat in terms of the increase compared to the prior year. Medical costs are just inflated. It just costs more to receive care. There's also have been expanded presumption for public sworn safety personnel and then aging workforce. So people are staying in the workforce longer, and that sometimes is attributable to injuries that occur on the job. And it also means that workers' comp payments, regardless of when the injury occurred, payouts are continuing longer in terms of permanent disability. For Alliant, the crime increase we're increasing to $2 million for coverage. So crime covers anything that might be as a result of fraud or theft, either a third party or someone we subcontracted with, there is opportunity to cover that loss through our crime policy. And then we have a very small bond for some lease space that we have, City and County of San Francisco with Western Surety.
Are we seeing that amount increase greatly, or is that just a proposal on the crime numbers?
The crime, it's a few thousand. I think it was like a 3,000. I have another slide that shows an overview of all of what the increases are, but it was the weighing and analyzing what the coverage change would be between 1 million and 2 million. It was very low in terms of what we would be able to cover versus the annual cost. And it seemed reasonable to just provide us that additional coverage and increase the from 1 million to 2 million.
Okay. Thank you.
Sure. So here's the snapshot of all of our increases. The first column is the actuals for 22-23, which is our current year. The second column is the estimated increase for this current year that we're going to start as of July 1st through June 30th. And then what that change amount is compared to the prior year and the change percent. So again, general liability is roughly 35%, which is still down from 55% this time last year. Property is generally the same. Workers' compensation between the excess and also the Department of Industrial Relations work comp self-insured assessment. Those two items combined is roughly 43%, and that's relatively flat compared to last year. Crime, you'll see the change amount is roughly 4,000, and that's with the increase from 1 million to 2 million coverage. Watercraft, cyber liability looks like a very stark percent change, but it's roughly 20,000. And the bond is flat. So overall, we're looking at roughly a 30% increase. This is actually down from 40% this time last year. So 10% improvement. We might see this manifest again next year, though, because it doesn't include 2023 winter storms and what that might look like for reinsurers next year.
Let's just hope for the best.
We're going to hope for the best. I never deliver good news. So looking forward, we're looking at the state of the insurance market. Back then, it was really looking at frequency or how often something was happening or how severe the one claim every so often might happen. Now we're really looking at frequency of severity, how quickly and how often things are happening that are bad. So, looking at 23-24, our goal is always to secure the broadest coverage for the district at the most reasonable costs. We're thinking about capacity when we do have losses, who can really provide us that cover, what JPA, what model, the stability. PRISM has long-term relationships with a lot of reinsurers, and given what we know as the state of the market now, even with the giant in the industry like State Farm vacating California in terms of property loss, it seemed reasonable and smart for us to continue to participate in the PRISM pool, just to provide us that security. There's lots of changing factors. And the focus this year is going to be, of course, on recovery related to the winter storms and working closely with finance to get us back up to where we are or where we were and better. So with that, the recommendation is for the Finance Committee to review the Park District Insurance Program and recommend that the full board renew our insurance program and authorize payment to the California Department of Industrial Relations for $175,000.
Okay, thank you very much.
Welcome.
And with the tough things we have to think about, thank you also for your positive thoughts as well. Would anybody like to make a motion on that matter?
Sure, I'll move.
Okay, there's a motion
I'll second.
and a second. Go ahead and call vote.
Sure. Shannon Rice, Recording Secretary, calling roll call vote. Chair Corbett,
Aye.
Director San Wong,
Yes.
Director Rosario.
Aye.
Thank you.
Okay, that's 3 votes in support. It passes. All right, and the next item we're going to, if you look on your agenda, let's make sure I have this right. It will be the first quarter 2023 general fund and other governmental funds financial reports. Is that correct? Is that where we are? Okay.
That is correct,
Thank
Director.
you. Go ahead.
Corbett.
When you're ready.
Start. Here we are. Good afternoon, Deborah Ocker, Assistant General Manager of Finance and Management Services. Today, I'm here presenting the first quarter financial results for the general fund and other governmental funds. The first quarter, of course, is very preliminary snapshot of the district's finances because many expenditures that we paid in January through March were for the work done in the prior year. So when we have the modified accrual basis, all of those charges get charged back to the prior year, and there's less activity showing up in this first quarter. So here, the report is in your packet starting on page 86. And we'll start with looking at a very high level of the general fund, which is the major operating fund of the district. This chart shows your total revenues and transfers in from other funds, expenditures and transfers out to other funds. And here you can see on this chart, the first column is the budget, which is the adopted budget, plus any budget amendments that have been approved through this first quarter ending March 31st. And then the second column are the actual payments paid. As I mentioned, things that were attributed to the prior year went into the December year end, December 31st year end. So these are the actuals as of March 31st. And you can see also on this chart that the expenditures of 70.7 million are greater than the revenue coming in of 17.7, which is typical for the first quarter. And it shows there's a net use of fund balance of 53 million. So I wanted to point out that is one of the reasons why we have significant reserves for the district, because in times like this, our property tax hasn't come in yet, and we've been spending throughout the first quarter. So the other thing I wanted to point out here is that our revenues and expenditures are as expected for this time of year. You can see the revenue is at about 8.8% of what was budgeted. Last year, it was at 9.3. So a little bit less than what came in last year. Maybe that has to do a little bit with the winter storms and a little bit of slower activity this year. And then on the expenditure side, we are at 31% of budget. Last year, it was 22%, so very similar to the prior year. I also wanted to point out on the budget column, you can see the net use of fund balance that we budgeted was a use of $25 million. Now, this is a little bit different than we've shown in the prior years because we're shifting the way we do budgeting a little bit. In the prior years, we would wait until mid-year and we would appropriate some of the savings that we had in the prior year. In this year's budget, we said we've estimated how much, and we want to put more into the annual budget process for transparency. So it includes some of those things. Also, one of the things different are projects. So the transfers in this budget are a little bit higher, and I'll show you on the next screen, are a little bit greater than they were in prior years because we really are trying to acknowledge all of the project work in our annual budget rather than bringing it to the board at board meetings throughout the year. So it's a little bit of a shift, and it is planned. That's how we're planning it. So just a little more detail on the general fund. And we have some notes in your report of what some of the variances are. But property tax is our greatest revenue source. And we do receive the majority of our property tax in April and December. So you can see there's not much received at by March 31st in the year, which is typical. Again, charges for services are a little less than what was expected and what we received last year. And I attribute that to just the lower amount of activity due to the winter storms. We had some things closed. People just weren't out and about as much in that weather. Our property usage is very similar and on track. The investment earnings and other. So really this is and other is what's in here. Remember, we have a pension trust. And so we decided we were going to add money to the pension trust. And then in the second part of the 10-year stint, we were going to start to draw on the pension trust. So in this budget, we say that we're going to draw on about $2 million out of the pension trust to smooth the rates. And also we're going to use that to pay down our PERS cost. So in July is when we make our advance payment to CalPERS, and we're allowed to receive significant savings when we do make that lump sum payment. And we are using that out of the pension trust this year. So about 2 million of that variance will happen in July. On the expenditure side, you can see salaries and benefits are the largest portion of expenditures, and we are on target. Supplies and services are slightly low here, but when we look at our encumbrances, which is our purchase obligations that we have out there, we are on target to spend. And then capital outlay is also looking quite low, but we are still having some significant supply chain issues. So when it comes to our equipment, major equipment and vehicles, we still have about $1.3 million from the prior year that has not been expended. We're waiting for these vehicles to get delivered, so that there's a little lag in that area. We do plan on spending it all. It's just the supply chain has got us backed up. And then in the other expenditures area, there's an annual payment we make to the Livermore Area Recreation and Park District. That happened in February this year. In prior years, sometimes we pay that in April. So it happened in this quarter. As I mentioned earlier, our transfers out are a little bit greater this year than they have been in the past. That is because some of our project and program work are outside of the general fund, so we can track it, make sure we're keeping track of grants that are also going towards those. But we do have amounts from the general fund that go towards some of these programs. And as I mentioned, we budgeted for those this year to cover that. So that is what I have to share about the general fund. Again, pretty much as expected for the end of the first quarter. Now, quickly, I'll just highlight, we do have our other governmental funds in different governmental fund types, and special revenue funds are made up of lighting and landscaping districts, zones of benefit, community facilities districts, our Measure WW local grant program, and some other small mitigation and gift funds. And those are also receiving fund, the majority of those are receiving funds similar to when we get our taxes. However, the local grant program does include a transfer of almost $8 million so that we can fund any remaining grants out to local agencies that are drawn upon. And that happened right when the budget was approved. So that revenue is looking like it's at 52% of budget. And the expenditures are on target for this time of year in those areas. The project funds, these projects happen, they're multi-year projects, and sometimes the timing doesn't match up with the exact budget. Our revenue side comes in on a reimbursement basis from the granting agencies. So we have an additional over $5 million in grants received in this quarter that were expended in the prior quarter. So there's just some timing differences in that area, and also the additional transfers in for projects. On the debt service side, this is where we collect our general obligation tax levy, goes in there, paid by the voters to pay our principal and interest on our Measure WW bonds, which fund our capital program, acquisitions and development, and those are on target. Our internal service funds is the last fund type, and that is where we're kind of doing business for ourselves. So as Alma just talked about, our insurance programs, those are in internal service funds, and the general fund departments and other special funds pay towards that. Workers' compensation, general liability, employee benefits. We also have our major infrastructure replacement and renovation. That's the MER acronym, and our major equipment replacement. So both of those are also internal service funds. And we just pretty much transfer 25% each quarter to fund those programs. And then the expenditures are as required by those programs. So that is the end of the other governmental funds. And that really concludes my report. The board operating guidelines and best practices do recommend that we do a quarterly report out to the finance committee, and then it gets brought forward for acceptance by the full board of directors.
All right, any questions, anyone? Great report, thank you. Yes, please go ahead.
Thank you. Regarding, revenue for our tax, has the extended tax reporting period affected how much money we're getting? I mean, coming in as revenue?
No, Director Rosario, the district does not receive personal income tax.
Oh,
That
that's
goes to the
tax.
state. And as you've read in the papers, the state is, they have ups and downs on how much personal income tax funds their budget, but that does not affect the district budget. The majority of our tax is property tax based on assessed valuation, which has been fairly stable.
Excellent, thank you.
All right, and another question, please go ahead.
Yes, at the previous agency I was at, we would sometimes, it might be more on an annual review, but we would also receive just like a quick summary of trends and things that are happening in regards to property taxes, in regards to, assessed values increasing or decreasing, the rate at which people are paying their property taxes or not paying their property taxes. So I'm not sure if this is something that's typically included maybe in an annual review or a quarterly review, but I just always found it interesting to know, especially since here at the Park District we're so dependent on property taxes.
Yes, thank you, Director San Juan. In August of every year, we work with our consultants, Beacon Economics, to do a review of our property tax projections. And then we report out to the Finance Committee as we're developing our new budget. We do cover 2 counties, so we're sometimes not as detailed as local agencies are. But we do also in Contra Costa County, we're on the Teeter program, which means the county kind of absorbs the delinquencies and pays us as we go. And on the Alameda side, we don't really do a report out on delinquencies, but we do keep an eye on whether we're on target or not. And we meet at least twice a year with the assessor through a Alameda County Finance Officers group. So in August, I believe, sometimes September, we come to the Finance Committee, depending on the timing of getting the assessed valuation. And we do talk in more detail about property tax.
And does that come to the full board, or is it really?
It's just really at the Finance Committee that we talk about the details.
I'll watch for that. Thank you.
All right, thank you. Any other questions on this one? If not, a motion is in order.
So moved.
Okay, we have a motion
I'll second.
and a second. Please call the vote.
Recording Secretary Shannon Rice calling roll. Ellen Corbett,
Aye.
Dee Rosario,
Aye.
Olivia San Long.
Yes.
Thank you.
All right. 3 votes in support, unanimous. Thank you very much. All right, we are on the last item, and it's a little different order, but we are on item number 3, which is item number 6. Job order contracting and quarterly reports. Welcome.
Thank you. I'm Ren Bates, Acting Chief of Design and Construction. I'm here to provide a quarterly update on our job order contracting program.
Thank you.
Bear with me while I pull up my slides. This is an informational item, so it's just for information. Again, this is a quarterly update in which we provide the status of the contracts that we have. Here we go. Thanks for your patience. Here it is. So this agenda item is incorrect. We have already studied that. I'll give an update per our job order contracting policy and procedures on our current round of contracts. So what we're talking about is the current round of contracts that were authorized on January 17th of this year. The board authorized to enter into agreement for 8 contracts. There are 3 general A engineering licensed contractors under contract. There are 3 B, I guess all A licensing contractors or utility heavy equipment sort of grading contractors. B licenses are building contractors, so they'll do lots of building renovations like roof replacement, HVAC, reparation and things of that nature. And then the last 2 contracts that we entered into are paving contracts in which the contractor has to do 70% or 60% of their own work. So we have a total of 8 contracts that we can utilize. Job order contracting is like on call where our contractors competitively bid an adjustment factor to a task catalog. I think this is all repetitive, but it bears repeating, I believe. So subsequent to the January 17th authorization, we executed contracts with all of our contractors. That included making sure everyone has the right insurance. We had kickoff meetings with our contractors, and now we've begun job order initiation. And so this table that's in here is in the packet that for the meeting. So because we've just gotten kicked off, we have 2 projects with a notice to proceed issued. So they're beginning construction on that. The bulk of the work right now is looking at all of our projects and getting contractors and staff out to do scoping of projects, and that the contractor can then begin pricing. So we currently have 13 as of a week ago when we made this. So I think we've added a couple more projects to the list, but these are the projects that are currently being priced and we hope to move forward with in short order. As a reminder, these are annual contracts. And so the term of the contract kicks off once we've issued a notice to proceed. So in other words, these projects below in the project pre-pricing and project review, the contract doesn't start for an annual term until we give a notice to proceed. So we get from that an NTP a year to get job orders in under the contract that we have. The Gordian, so this graph shows the approved project cost for that job order, and then the Gordian Group gets a 5% fee for that approved project cost. And again, this is the total fee for the Gordian Group for all of their services. And so they get paid once we issued a notice to proceed. They don't really get paid for the work they do for helping us to bid, compile a construction task catalog. Those fees are all incorporated into these 5% fees based on the total job order cost. Typically, this is when I would show you a bunch of slides, but since we've just gotten kicked off, I don't have a lot of projects to show. This is a repeat. You'll probably have heard me talk about the Cogswell Marsh. This is our 5th or 6th year doing these. This actually is one of the reasons or one of the types of projects that job order contracting is great for. The image on the left shows night work, and our contractors bid adjustment factors for regular hours and off hours. So this allows us, because the work here is tidal and then we can't do it when there's water in place. It allows us to get pricing and schedule on a more flexible basis than going out to just design our regular design bid build. So next quarter, I hope to come back with numerous photos of projects as they will be in construction. Again, this is an informational item. I'm happy to field questions at this point or share anything else you may have.
Thank you very much. You're a little busy, aren't you?
Yes.
Thank you. Any questions?
No questions. This is very informative. Thank you.
Sure.
Yeah.
Just have one.
Yes, please go ahead.
And just looking at the projected projects, the 13, I'm assuming those are all over 50,000.
Yes.
Okay. Cool. Yeah, that's it. Thank you.
Sure.
Okay, thank you very much for your
Thank you.
report. Some of us might want to go out and take a view of what you're doing one of these days. We'll let you know. Thank you very much. All right. Any other comments, members? That's the last item on the agenda. Yeah, I was going to ask for that. Do we have any public comment? We
I
don't-
have not received any, no.
We have not received any public comment. All righty. Oh, please. Go ahead, please. Sorry, I was. I knew you were here.
Can you hear me okay? All right, good afternoon, members of the board. My name is Meadow Darcy and I am representing ASME Local 2428 today. The first thing I wanted to mention was I believe the Brown Act requires that public comment occur before or during the item. When public comment occurs at the end, then a decision may already have been made. And so the public doesn't have an opportunity to weigh in or give their comments. So I'm hoping that someone could look up the Government Code 54954.3, Section A, to confirm that it does need to occur before or during the item. The second item I would like to talk about is jock contracting. So I think Dee's been here quite a few times when I've been up at this podium at Board Finance. And one of the things that I brought forward, but have not really gotten addressed, is that a lot of times it seems like projects go out to jock when some of those projects could occur in-house. And while there is a place for jock, there are some major large projects that need to be done and contracted out immediately, and we don't have the skill set. But in other cases, we do have the skill set and there may be a staffing issue that is not being addressed. One example is paving. I've been coming to Board Finance for several years and requesting someone to sort of take a bigger look at paving and how much paving we do. We're spending millions and millions of dollars every year, and yet we have roads and trails crew that can do a lot of that work. And because we don't have enough staffing, or because we're told that jock is irregular and not, something that occurs all the time. But as I see more and more money being spent on paving every year, we've asked for that sort of macro look to be taken to see if that work can be done in-house. So for example, I see on the jock list, there's seal and stripe the parking lot here at Peralta Oaks. And that is certainly something that our staff could do. Recently, there was a heavy equipment operator that was vacant for over a year. Another heavy equipment operator has been vacant for 3 months. And we have been asking at Meet and Confer time and time again to please post that for acting to fill the position. After much prodding, the district finally did post those 2 positions for acting. We got 2 very well qualified candidates that put in. And after that, the management decided to only hire 1 person for acting and not the other, with no explanation, just that they decided after they posted it that they were just going to hold it vacant, maybe to fill later as an apprentice. And we said, you can still fill it in the meantime. There's lots of projects that need to be done. So those are things that come up that we see. And I don't think anybody's intention is to try to contract out union work, but I don't think there's anybody also watching to sort of evaluate these things on a regular basis to say, hey, here's a project that really could be done in-house. Why aren't we doing it? And look, there's several vacancies that have been vacant for a long time. Why is that? And really looking at that. Or maybe with paving, maybe we need a paving crew. Maybe that's something we could look into, especially if we're spending millions and millions of dollars year after year after year. So I think the last time I came and spoke on this was, I think the first time I spoke on it was like 3 or 4 years ago. So I keep bringing it forward, but I don't really get a solid answer as to why that's not sort of evaluated. So thank you.
All right, thank you. And if we missed items to call to see if you had something to say, my apology. But just let us know. If we've forgotten to say, does anybody have anything to say? Just remind us. Thank you. Yes, Steve.
To response, yes. In fact, to your point about the survey, you don't need to be up there.
Why not?
Okay. I just got a report that the analysis of the roads and trails crew has been done, and so we should be getting that soon. So
okay, that would be great.
I understand it got handed over to the general manager, so I hope to see that in operations.
Okay, thank you.
Thank you. No, I appreciate your persistence. It's taken a while. Thank you.
Yes, thank you. We're not perfect, but we like to listen to what people have to say. Thank you. All right. Anybody else have anything else to say? All right, with that, the meeting is adjourned. Thank you all very much. Thank you for all your work.
Thank you.
Oh, if we have time, we're supposed to talk about scheduling of this committee. Are we gonna continue to have it? What are we currently scheduled for the last
I
last Wednesday of the month, or